Hi everybody, this is Thomas from Wynn Capital with a review of the market for the third quarter. And on the screen is all my contact info. If you have any questions, give me a call or an email, and I'm going to go through these quickly. So pause the video if you want to look at any slide in more detail. So here we go with the summary. We can see that the three equity indexes of the US, international developed stocks, and emerging markets all down slightly. Emerging markets down a little bit more than the others. We'll talk about that in a future slide. Bonds up slightly. And below you see the context of the best quarter and the time that it happened, and the worst quarter and the time that it happened, and what the averages are. This gives a little longer view. These more than 1 year is annualized, so these rates of return for the US market for 5 years is 16.85 per year, and the same down for the 10-year period. And we're in a very strong and very long bull market, so returns are far above average for longer periods. This is a picture, just shows a graph of performance above, and it looks kind of flat for the third quarter. And this is all countries all together in the world stock market performance for equities. And then it's got the news below. And as you all know, the big news is the current inflation. I'm going to deal with that, talk about that a little bit in a couple of different slides. This is just zooming out. That was a third quarter. Now we have a full year, 12 months, and the news that was associated with it. The inset here shows a very long period. It shows this the bull market started really at the end of the real estate decline and has been going up since 2009. So we're in maybe year 12 of a bull market, and there was small stocks are starting to do a little bit better. They've been underperforming, but now they're starting to do a little bit better, which helps us because we overweight small cap value. This is the world asset classes, all the types of different asset classes. And we can see that most of the asset classes were down. Emerging markets, as you saw in one of the early slides, was down a lot. China is down 18% for the quarter. They've got all kinds of issues. There's a company called Evergrande, a real estate company that appears it might default on its debt, and that's causing a lot of fear in the Chinese market. U.S. stocks, there's going to be three slides in a row that look at U.S. developed countries and emerging markets, all with the same data. In the upper right, these are the asset classes, relatively flat, but large growth was up a little bit. Then there's long-term performance down here, all the way out to 10-year annualized performance. And I've highlighted that small cap in general has underperformed large growth. I also wanted to point out that the U.S. market is 59% of the global market. The value of all shares, the U.S. is 60% of all global shares. Most people don't realize how big and powerful the U.S. is financially. This is the same information for developed countries. Depending on the index, there's and only 30%. This is Europe, Japan, all the other developed countries. Depending on the index, it's 23 to 37 developed countries. They define them differently all the time. And I'll show you in other slides. We're going to take a look back at 2013 and see how much this has changed. So here we are, emerging markets. 12% of the globe is in the emerging markets, which includes China, and the returns for the classes and returns over time. So now this is a snapshot of the U.S., and it's pretty amazing that the U.S. in the last 8 years has gone from 50% of global asset market cap to 56 or 59%. It's also interesting to see that back in that time, there had been a long period of outperformance by small cap value. So these dimensions of expected returns ebb and flow, and you have to stick to your guns if you want to capture the returns. And it's no secret. There is just more risk in small cap. There's more risk in foreign and emerging markets. they have more volatility. Over time, they have longer returns. And we tilt our portfolio towards those, what we call dimensions of expected returns. And this is 30% now. In 2013, the developed countries at 40%. So we've been getting bigger and bigger. Money's been flowing into the US markets. Companies have been doing well. And we're getting bigger and bigger relative to the rest of the globe. And emerging markets, even though developed markets shrank, global emerging markets rose from 10% to 12%. Just an interesting thing to see how big the US is. So this is performance by country, and you can see at the bottom, it's divided on the left to the developed countries and on the right by emerging markets. And you can see that China and Brazil were at the low end, with China down 18% for the quarter. So that's speaking about the problems they're having with their real estate. There's lots of other issues with China, which has grown, double-digit GDP for many, many years, but now it's starting to slow down. China's 1/3 of the index of the emerging markets. So when it moves, it brings the index. I mean, half were up and half were down, but China's so big that it showed it was like down 8% for the entire index. US was right in the middle of all the countries with very flat returns. I don't always look at commodities, but I want to point out that this obviously is a big part of the inflation story. And many clients have called me. I don't believe there is going to be long-term high inflation, but we are taking steps to mitigate inflation if it happens by using Treasury inflation protected bonds, what they call TIPS. So we're adding those to our bond mix. They don't hurt us if inflation doesn't. They're like regular bonds, but they have an inflation component. So if inflation does appear and endures and gets high, we'll be protected in part of our bond portfolio. But there's lots of other things we can do to mitigate inflation if it happens. What I wanted to point out on this slide is that, this is this quarter, and in the short term, for the quarter, for the year, and for the rolling year, going back to 2020, when there was a tremendous decline in all these commodities because no one was doing anything because of the pandemic. If you go out, there's a little inflation over the 3 and 5 year periods, but over the 10-year period, this basket has been deflating. And that's been the case for many, many years. You only get 10-year negative inflation or negative performance if there's a lot of declines over a longer period of time. So let's go take a look at the first quarter of 2020. And as much as things inflated since the pandemic, this is what happened in the first quarter of the pandemic. So we had a 23% decline in the quarter, and et cetera on down the line. And because that quarter was so bad, on top of many, many other quarters, there was deflation in this basket, which is, you can see, many of these are staples. And, the most important one is oil. When oil goes up, which it has gone up, which is really one of the big drivers. Everything has to get from one place to another. So oil, when it goes up, inflates the price of everything. But when you have unleaded gas and crude oil going down these amounts, it takes a tremendous amount of gains to recover. Because remember, a 50% decline from 100 to 50, a 50% rally back only takes you to 75. 50% of 50 is 25, 50 and 25 is 75. So you've got a 50% decline takes 100% rally to get back. So these all got crushed, and the inflation story is really a story of going from very, very low numbers back to something similar. Now, there are, of course, used cars and lumber, microchips and other things that are inflating above their old prices. But in general, that's part of the reason why the inflation, most economists don't believe inflation is going to endure. So this is just the end of the article, the end of the DFA summary. And this one talks about DFA's founding 50 years ago, how they were at the forefront of inventing the index fund, which is a basket of stocks that just captures the returns of the market and doesn't try to stock pick or market time its way. They, of course, are not, DFA is not an index fund. It's an active fund. It just has the fees of an index fund. So their expense ratios are very similar to Vanguard. And I'm not going to go into all the details, but Vanguard has, their mandate is to match the returns of the index minus fees, and DFA's attempting to beat the indexes that they participate in by tilting their portfolios a certain way and how they implement their strategies, how they buy and sell. And they do a lot of innovative things, and they have performed well over time. So there's 2 pages of that. And again, my contact info. And I hope you find this all helpful. And if you have any questions, give me a call anytime. Thanks. Bye-bye.